Hi. Whenever anyone is managing money on your behalf, it's really important that you understand how they're going to do it, what their approach is to investing, in other words, what their investment philosophy is. So whether you've been a client of mine for some time and you could do a recap because you've forgotten what my approach is or you never really understood, or if you're new to the relationship and you want to understand for the first time how I'd go about managing money on your behalf, this video is going to break it down into the main component parts for you to hopefully give you a greater insight about my investment philosophy. So to start with, it's about applying academic evidence. And a lot of this has come from research over multiple decades by Nobel laureate winning academics at the University of Chicago in America. Now, I'll do a collection of videos to break this down further to explain what drives market returns. But for now, it's just to understand that these investment decisions that we make are evidence-based, looking at academic returns, academic work, rather than just sticking a finger in the air and trying to second guess what's going to happen with the markets. Another key part is that when you're investing, you need to do so over the long term. In the short term, markets are very volatile and we don't know what they're going to do next. But over the long term, we know that stock market investing will provide greater returns than any other asset class. If any portion of your money you might need within 5 years, within the short term, it isn't appropriate to invest it because there's always that chance that you'll need the money, and if it was invested, the stock markets have crashed, and so you get less back than you put in, which isn't a good outcome. So always invest with a minimum of 5 years, 5-year view. Another important part of my investment philosophy is that active management doesn't work. So active management is when you pay a fund manager extra money in terms of an annual management charge to rely on their expertise in inverted commas, to decide which companies to buy, which ones to hold, which ones to sell, and which stock markets to get in and out of and when. Now they'll say that they've got the resources and expertise and experience to deliver markets above returns above the market. But again, all the evidence shows that this isn't the case. A fund manager might have a good period and look like they're providing superior returns relative to the market and their competitors, but more often than not, in the subsequent time periods, their returns will just revert to the average. So after charges, particularly fund management, active fund management doesn't deliver additional returns. And you can't time markets. Some people will think they'll be clever, and this could be amateur investors as well as the professionals, and think, well, the markets are very high, we're going to sell out, take our profits and wait for them to crash and get back into the markets. But no one can do this successfully on a repeated basis. You might get lucky once and miss a crash, but it's next to impossible to get back in time and enjoy all of the upside. And even if you're able to do that, you won't be able to do it over future investment cycles. The successful investor invests with patience and discipline, accepts the swings and peaks and troughs of stock market investing, doesn't try to time them, and importantly, when markets crash, they don't panic out and sell, because then you have definitely crystallized losses. If you think you're the sort of person who is going to want to sell their holdings when markets have crashed, then probably long-term investing isn't for you. And it's also really important to keep costs as low as possible, and that comes back to that active investing as well. The more you pay in costs, the less pounds and pence you'll get back in your pocket. So that will be whether you're paying a fund manager more each year, or whether that fund manager is doing a lot of trading in and out and buying lots of stocks and getting in and out of markets. Because the more trading that occurs, the higher transaction costs you will occur, which means less money in your pocket. So by investing in broad market indices like the FTSE 100 or the S&P 500 in the US, invest broadly and keep turnover of the portfolio low is a much better way to generate long-term returns. And finally, a really important point is don't play someone else's game. The only return that matters is the one that you need to achieve your lifetime priorities, whatever they are, and they're absolutely unique to you. Everyone's circumstances are different. Everyone will invest a different amount of period for a different time with a different purpose. You might have friends, someone in a golf club, someone in the pub saying they've hit a surefire winner and they're making really high returns, they're enjoying really high returns. Chances are that you won't hear when they turn sour. All that you need to do is invest simply, as I said, in a manner that's going to help you achieve your investment goals over a particular time period. So I hope that helps. As I said, I'll cover a bit more on the sources of investment returns in a subsequent video, but for now, hopefully that gives you a bit more of a flavour and an insight into my investment philosophy and my approach to investing your money.